Howdy, folks. Welcome back. It is the weekly wrap-up for August 8th, 2022. Not August 8th, August 5th. August is the 8th month. So hope everybody's having a great day out there. It is a warm Friday here in Colorado. Like I've been saying, the warm weather's starting to disappear out here, but today it is warm and still. I think that's probably the worst part of it, is that there's no breeze. And when there's no breeze, it is really, really hot. So anyways, beer sticking out the side. Anyways, ignore that. Like I said, hope everybody had a great week. And if it's your first time watching, give me a big old thumbs up. I would greatly appreciate it. A like, a share, a subscribe. And let's go ahead and jump in and see how things turned out today. It was kind of a back and forth day in the markets. The three major U.S. indexes kind of bounced around back and forth, but one out of the three finished in the green. So the Dow Jones finished up today, 0.23% at 32,803. The S&P 500 was down 0.16, closed at 4145. NASDAQ was down 0.5%, closed at 12,657. Small caps were up almost 0.75 of a percentage point. The VIX was down again today, 1.35%. It's currently hovering around 2115. The other American indices in Canada, they were up 0.22, Brazil up 0.55, Mexico down 0.41. Jumped across the pond in Germany, they were down 0.65, UK down 0.11. Let's see here. This is France down 0.63, the Euro stocks down 0.78, Netherlands down 1.21. Spain, one of the outliers, finished up slightly at up 0.08%. Let's see here. Italy down 0.26, Switzerland down 0.71, and Portugal finished the day up 0.68%. Moving a little further east, over in Russia, the MOEX was down 2.94, so was the RTSI. Over in Asia, Japan finished up 0.87, Australia up 0.58, New Zealand was down 0.38%. Over in China, the Shanghai was up 1.19, the SESE component up 1.69, China A50 up 0.9%, DJ Shanghai up 1.41, and the Hang Seng up 0.14, and the Taiwan weighted came in 2.27% up. So, like I said, kind of a mixed day. Looks like the Asian markets were pretty good in the green. A lot more red across the European markets. Like I said, just a few outliers. Portugal and Spain were the two up markets there. And then here in the U.S., just the Dow was in the green for the day. So let's go ahead and see how things did for the week. Let's see here. The Dow Jones looks like it's going to finish the week basically flat, up about 0.12%. The S&P 500 looks like a little bit better, up 0.7% for the week. NASDAQ up 2.1% for the week. The Dow Utilities finished the week down 0.89, and the Dow Transports looks like it's going to be fairly flat at up 0.26%. So, we had a lot of volatility this week. Again, here's the Dow. You can see, early in the first day of the week was pretty decent. Then Tuesday was kind of cruddy. Wednesday was pretty good, and then kind of flat the last 2 days. So let's go ahead and zoom out and see how things are doing for the year. Right here is the start of 2022, and you can see that since that time, the market, at least the Dow, has been down as far as about 19.4%. Currently, right now, we're sitting at about almost 11% down for the year with this rally we've had the last couple weeks. Same thing with the NASDAQ. You can see here, where is that? January 4th. It's been down as much as 33%. And currently we're sitting at about 20.85% down on the NASDAQ. with the S&P 500. It's worse so far. It was down about 24%. Currently today, it's sitting at about down 14. So as far as the three major indexes here in the U.S., again, it looks like we're between 10 and 20% is where things stand right now as far as being down for the year. So let's go back to the Dow, and we can see this trend line and or resistance line that we've lined up here. And each time we bounced off it. This is probably the furthest we've gotten away from it of the three times we've broken this line of resistance so far this year. And then if we zoom in, you can kind of see it looks like a lot of that steam has worked its way out, and I would not be surprised to see this fall back below this resistance line here in the next week or two. Again, because nothing else has really changed. So, we certainly could, again, this trend could continue in an up northeastern direction. I just don't see it based upon everything else going on. Some other good news to look at is like down here on the momentum indicator. It looks like we're about to cross back over into positive territory. I personally think that's going to be short-lived. If it goes above the midpoint and continues in a positive trend, I'll have to make some adjustments and reallocate. But as of right now, I'm just going to stand pat where we stand with things. So, all right. Well, that's where the markets stand so far this year. Again, not great, but it is what it is. All right. Well, let's go ahead and look at some of the economic data. U.S. initial jobless claims came in at 260,000 this week. Forecast was 259. We covered this yesterday in an article, so not too far off, but not great. And as we can see down here, this is the highest it's been at 260,000 since, when was the last time we were over that number? January 27th of this year. So basically, over the last 6 months, we've gone from about 260. We bottomed out at about 166 in April and have been on a fairly steady little increase here over the last couple of months. Let's see if we can zoom in a little bit. Yeah, so we can see here where we bottomed out in April, and then just a slow, steady trend back upwards. Again, wouldn't freak out too much about it because we are pretty much back to where we were as far as what we consider normal over the last decade or so. Continuing jobless claims came in at 1.416 million. The forecast was 1.37 million. So missed the forecast by quite a bit. Pretty sizable jump from 359 last week. 1.359 up to 1.416. So it does look like the jobs numbers are not looking as great. We did, and we'll cover in a few minutes, the employment and participation rate are kind of disjointed as far as the way I see it. So the U.S. ISM Manufacturing Purchasers Managers Index came in at a 52.8, above forecast of 52. But again, we can see that over the last few months, we've been slowly trending in a downward direction. So again, it looks like the economy is slowing from at least from a manufacturing point of view, but we'll see where that bottoms out long term. The U.S. Job Openings and Labor Turnover Survey, there were 10,698,000 jobs available. Forecast was 11 million, so just a hair under. And we can see we peaked at, May 3rd. The May 3rd report was the peak, and we've slowly been falling back. It looks like we're about even of where we were in January as far as those numbers. So, but again, there are plenty of jobs out there for folks. If you're unhappy with what you're doing, there are jobs open. I mean, from what I hear from just talking with folks, is that a lot of times it's just hard getting people who are qualified to do what they're hiring for. It's not necessarily a matter of having people to interview. It's having people that are a right fit for the job. All right, U.S. factory orders month over month came in at 2%. Forecast was 1.1, so we did increase a little bit there, which again, some positive news. The U.S. unemployment rate fell from 3.6 last month to 3.5 where we're at. Forecast was 3.6. And again, good news. For those who want a job, there are jobs out there and there are people working them. Although the U.S. participation rate fell to 62.1 from 62.2. So, the unemployment fell, but the participation rate also fell. So it's kind of, are people just leaving the job market altogether, or are there other factors out there? So, all right, well, let's go ahead and breeze through the market recap for today. S&P 500 slips as surging U.S. yields dent tech amid blowout jobs report. Written by Yassine Ibrahim. The S&P 500, the S&P 500 eased from its lows Friday, but remained under pressure by a fall in tech after a blowout monthly jobs report stoked expectations for larger rate hikes, sending Treasury yields surging higher. The U.S. economy added 528,000 new jobs in July, topping consensus for 250,000 new jobs in June. While the unemployment rate unexpectedly fell to 3.5%. The jobs report also flagged an uptick in wage pressures that will likely keep inflation elevated and give the Federal Reserve the green light to continue front-loading rate hikes. Traders are betting the Federal Reserve's peak interest rate, or so-called terminal rate, is 3.6%, but this won't be enough to stem inflation given the strong labor market, Jeffrey said. Quote, the terminal rate currently priced in to the yield curve looks woefully inadequate. We expect the Fed to keep hiking through Q1 2023 until they push the federal funds rate to 4 to 4.25, Jeffries added. If the Fed turns more hawkish than expected, quote, the market will take that as a big negative because right now it's pricing in a Fed funds rate that's nearer to the end of the cycle, end quote, chief market strategist David Keller at Stock Charts told Investing.com in an interview today. 2-year U.S. Treasury yields, which are sensitive to Fed rate hikes, jumped to its highest level in nearly 2 years. The 10-year yield also soared, rising more than 6%. Growth sectors of the market, which tend to be unattractive in a rising rate environment, were hardest hit, with big tech and consumer discretionary stocks leading the downside. Tesla led the move lower in consumer stocks, down 7% after shareholders backed the company's proposed 3-for-1 stock split. The earnings front, meanwhile, served up mixed quarterly results, with Lyft the standout performer on the day, following stronger than expected earnings. Lyft jumped 7% after the ride-hailing company reported a surprise quarterly profit as demand jumped to pre-pandemic levels. AMC Entertainment reported a slightly wider than expected quarterly loss and announced that it would issue dividend to all common stock shareholders in the form of preferred shares. Ooh. The move in effect, quote, creates a 2-for-1 stock split with half listed as AMC and the other half under APE, Wedbush said. Block fell 2% despite delivering quarterly results that beat on both the top and bottom lines as investors digested a 34% slump in its Cash App business. All right. So again, kind of a good news, bad news. It's, kind of the theme of things of late. So don't be surprised if things get a little more rocky with the expectation that interest rates are going to go up even more than expected with the jobs numbers and everything else considered. All right, next article here. Bank of America says take profit on bear rally as stock outflows resume. Investors have resumed shunning global stocks in favor of bonds, according to Bank of America corporate strategists who say the time is right to step back from U.S. equities after a strong rally in July. Global equity funds had outflows of $2.6 billion in the week through August 3rd, according to a note from the bank. After last week seeing their first additions in 6 weeks, U.S. stocks had redemptions of $1.1 billion, and while $4.1 billion left cash, global bonds had additions of about $12 billion, the most since November, Bank of America said, citing EPFR global data. Strategist Michael Hartnett, who said the recent rebound in stocks was more of a bear market rally than a sustained run higher, I think I just said that, reiterated that investors should fade the S&P 500 index from a level of 4,200 points, just 1.2% above the latest close. He maintains that the bottom for the benchmark is below 3,600 or 13% below current levels. U.S. stocks have struggled to maintain their momentum in August after relying in July on the back of better than feared earnings season and bets that the Federal Reserve will slow the pace of interest rate hikes. The technology-heavy NASDAQ 100 is nearly 20% above its June low, but strategists have said stocks are likely to fall again until profit estimates see much stronger downgrades. HSBC Bank strategist Max Kettner, a staunch bear on U.S. stocks this year, was the latest to warn about a sharp end to the rally when saying on Thursday that he'd changed his stance on equities to maximum underweight. JP Morgan Marco Kolanovic is now one of the few top strategists forecasting a rebound for U.S. stocks in the second half. I think that guy might be wrong. Bank of America's Hartnett said that while investor sentiment remains bearish, shorts have been covered. The strategist expects the S&P 500 to trade in a range of 3,800 to 4,200 until the next Federal Reserve decision on September 24th or 21st, he wrote in the note. The bank's European strategists, meanwhile, have cut their view on regional equities to negative, saying their macro projections point to a 10% downside for stocks by the end of the year. European equity funds had outflows of $3 billion in the week and their 25th straight week of redemptions, the data on fund flows showed. In terms of equity flows, the style factors, U.S. growth and small caps had inflows, while large caps had the biggest outflows. Among sectors, consumer and financials saw the biggest additions, while materials and real estate had outflows. So yeah, it's like I've been saying the last couple of weeks, I think this is more of a bear market rally than anything else. But again, I'm not married to any one decision. I just follow where the momentum takes us. All right. Next article here has to do with people spending too much money on credit cards. Consumer credit surged in June, second largest monthly increase ever. This comes from our friends here at Zero Hedge. Last month, we began to see the first signs of consumer cracking as credit numbers slowed drastically after months of spend-heavy consumption amid tumbling real wages. 1 month later, and June data released today by the Fed showed that consumer credit rebounded dramatically with an additional $40.154 billion piled on, well above the expectations of a $27 billion rise, so almost double. That's the second largest monthly spike in consumer credit in history. Non-revolving debt funds less discretionary items such as cars and college education surged by a record $25.35 billion in June. Revolving credit debt rebounded in June with an increase of $14.799 billion. Bottom line, the renewed reliance on revolving debt to maintain lifestyles in June when gas prices were soaring to record highs suggests that the consumer is anything but, quote, happy, as the sentiment surveys make very obvious. What's worse is that despite today's anomalous surge in payrolls, surging initial jobless claims from a new wave of corporate layoffs combined with soaring inflation at an all at an all-time high, when most marginal credit cards are maxed out, will make the pain across the U.S. consumers unbearable and will come just as most households are tapped out and no longer have dry powder on their credit card for discretionary purchases. In short, the recession, which officially started in Q1 and worsened in Q2, is about to get much worse in Q3, as the composite PMI suggested this week. When the key support pillar of the U.S. economy, consumer spending, which accounts for 70% of GDP, goes into reverse, now that maxed out credit cards have to finally be repaid. So yeah, that's, from my previous career in the credit and collections field, anytime, revolving debt starts to rise at the same time that the economy is, kind of floundering, that's usually not a good sign for the long term. All right. Last article here. JP Morgan says 75 basis point hike in September looks likely, with Goldman still sitting at 50 basis points. According to superficial reads of today's job report, which, however, are sorely lacking for reasons we explained earlier, The July jobs report blew the doors off expectations, in the words of JP Morgan, as non-farm employment increased by 528,000 and the unemployment rate ticked down to 3.5%, the lowest in over half a century. What does that mean for the Fed? Well, as we noted earlier in a handful of Wall Street knee-jerk reaction we summarized, many strategists believe that a Fed pivot is now out of the picture and a 75 basis point hike in September is all too likely. And what they're talking about, God, I'm a mess. And what they're talking about there is that if, the hope is that the jobs numbers would start to weaken and would give an excuse for the Federal Reserve to step back in and either slow the amount of tightening that they're doing or potentially maybe do some additional quantitative easing. The people in the public, or at least on one side of things, are really cheerleading to go back to a zero rate environment and to go back to the way it was. But the way it was is what created all this inflation and problems that we're dealing with now. So again, you read a lot of bias, not so much from Zero Hedge, but from like your AP and Yahoo and places like that. In this post, we'll focus on just two, the most important ones, the views of JP Morgan and Goldman Sachs. Starting with the first, JP Morgan's chief economist Michael Feroli writes that this morning that today's number should mollify recession fears, but amplify concerns that the Fed has a lot more work to do, end quote. And he thinks that a 75 basis point hike in September looks likely. He continues, the inflation worries motivating the Fed will only be heightened by this jobs report, as average hourly earnings increased a firm 0.5% last month and were revised up a tick in June, leaving the year-ago figure running a hot 5.2%. The work week was unchanged at an upward revised 34.6 hours. The only disappointing detail of the July numbers was a tick down in the participation rate to 62.1%. Excuse me. It's still early days, but we continue to pencil in a 1% for Q3 GDP growth. Unless that tracking is revised up substantially, we could be in for another challenging quarter for both productivity growth and corporate profit growth. For the Fed, JP Morgan continues to look for two more 25 basis point hikes in November and December, bringing the terminal rate to 3.5 to 3.75. However, the update is that unless the data stumble, a case could be made for going more than 75 basis points at the next meeting. Though he adds that if the FOMC rejected that opinion in June and July, it would seem to have an aversion to ripping off the Band-Aids. So far, they also seem averse to hiking inter-meeting, end quote. What about Goldman? For the most part, the bank's assessment was similar to that of JP Morgan, full of superlatives, although we expect the bank will refocus on the household survey weakness as it did last month. However, when it comes to the Fed, Goldman was more sanguine and wrote that, quote, today's report indicates an overheated labor market that continues to tighten further. We continue to expect another 100 basis points from the Fed rate increase over the next three meetings, 50 basis points in September and 25 at November and December's meeting, with risks skewed towards an earlier or larger increases, end quote. The question now is, what does next week's CPI print show? Because with everyone all hawked up, the last thing the market needs is a huge inflation miss, pushing everyone back to square one. So yeah, that will be interesting to see what the inflation numbers look like next week. But again, just expect more of the same. It's going to be really rocky, really volatile until we get inflation back to what the Fed considers normal. I'm not a fan of the 2% goal that they always have. But anyways, it's just going to be rough. And if you need some help with that, I know a guy, me. You're welcome to go to dsafinancialgroup.com. All my contact information's there. So if you want to book a meeting, drop me a phone call or an email, please do. I'm always here for you. And that's everything I had for today. Hope everyone has a fantastic weekend. Astros are in Cleveland for the weekend. They played a game last night and got 3 more. And Sunday's game will be on Peacock. So if you do not have a Peacock subscription, you will not be able to watch the Astros if you're in the Houston area. So anyways, all right. Well, again, I hope everyone has a great weekend, and I'll be back on Monday with the weekly update. See you then. Bye, folks.